Perfect. Hello, everyone, and welcome to this webinar. Today, we will discuss the art of startup and due diligence with Luis Solana. My name is Francisco Mariscal, VP of Angeles Ventures, and I will be moderating today's discussion. First, a bit of my background. I'm a former founder and early joiner of a startup called Credit2. After that company was acquired, I decided to pursue my MBA at Kellogg, where I discovered my passion for VC and venture capital. I began as an intern at Angeles Investors, continued for almost 1 year at City Ventures, and in 2023, I came at Angeles Ventures to launch Angeles with the challenge of launching Angeles Ventures Fund 1. Fast forward, we already have done 7 investments and analyzing many opportunities. At Angeles Investors and Ventures, our mission is to back the best early stage startups while empowering our members with tools, frameworks, and insights to become stronger investors. So that's why today's session is all about one of the most critical parts of investing, due diligence. So whether you're a seasoned investor or just beginning in your angel journey, our goal is to leave you with practical frameworks, real-world examples, and actionable tips to evaluate founders, market, business models, and make you more confident in your investment decisions. So before we dive in, let me introduce Luis Solana. Luis, great to have you here. Please feel free to give a brief background of yourself and what you do.
Thank you, Francisco. Thrilled to be here. Good afternoon to everyone. I think it's afternoon for most of the people joining. So I'm thrilled to be here. Luis Solana. My background, very simple. I'm an operator that for years I ran all kinds of complex supply chains, and now I've turned to the investment side of the supply chain. That is my passion today. Several of you know that a little bit still on stealth mode, but I'm actively starting a venture capital supply chain tech innovation fund that keeps the bulk of my time in use. And I'm excited to be here to talk about, at least my philosophy, my perspective on how to evaluate startups and what makes in that due diligence process a potential successful investment for anyone. So happy to be here, Francisco.
Thank you, Luis. So let's begin the discussion. On my eyes, due diligence is often described as both art and a science. On one hand, it involves checklists, financial elements, legal reviews. On the other hand, it involves people, vision, markets. So those elements are not quantifiable. So, and also depends on a lot on the type and stage of the deal. For example, my view is that pre-seed deals require very different approach than late-stage deals. Similarly, when I analyze an AI SaaS startup, will be very different from one a biotech or a health tech company. So, Luis, what's your view? Do you follow any specific framework when doing due diligence?
Yeah, I've I've stolen and created my own thesis of our investment, building from best practices from several people that I've learned from. One of them being David and Adela, some of them. So the way I think it is, I think if I had to succinctly say it is, I like to target exit focus investments, and those are three very deliberate words, which are anchored on differentiation, where talent, another key word, is really accelerating a value proposition that has positive momentum. And each word I carefully selected it, and I can, during the conversation, I'll talk a little bit more, but is exit, focus, differentiation, talent, value proposition, and momentum. So.
And when you analyze a supply chain deal, how that approach changes from another type of deal that I know that you're an angel investor?
Well, I probably gets the bar raises from my perspective because I'm the guy that a lot of startups and technology companies, due to my years of being in corporate America, were knocking on my doors and they always wanted, oh, give us a try. You should use this tool. So I've seen the other side, and because I've seen good and I've seen really bad as well. I would say the only difference to anyone else is because I'm an operator background, that makes me more critical and more I'm more pointy, asking questions to entrepreneurs to really understand what they're trying to do or suggest that they're trying to build. So,
And if I had to ask you three factors in which you concentrate in the analysis of startups, which those three factors are?
yeah, so I always, I always start, and it goes again, building. If it's a supply chain startup, the first one is, what are you trying to do? Explain it simplistically. Which problem are you trying to fix? Okay, and that normally takes people a little bit by surprise, but to me it's so fundamental. They immediately jump into terms and solution and tech design and all that, which is important. Don't take me wrong, but before anything, explain what you're trying to fix. So that would be number one. After that, I truly believe that a lot of entrepreneurs and the startups are really accelerate their potential because they have very driven, hardworking, smart teams. Okay, and really that to me the people component is paramount, especially more even I would argue for a startup. And the third one, I would probably say, you need to see some traction, some momentum, right? You need to see, you know, and I know we're going to talk a little bit more about that, but you need to see that things are starting to happen. And there's different ways to quantify it, but before even considering investing, there has to be some momentum happening, right?
Yeah, I love that. And to be specific, for every opportunity that we have, at least in Angeles Ventures, when we decide to present them to investment committee, we have a memo together. That memo has 5 sections. The sections are one, exactly what you said, team. Second, market. Mode, what they're doing and why they're special. Traction, and product. So with those 2 sections, I want to give to my second uh, stage of the discussion, that is to really think about frameworks and questions. What are the best questions to ask during our due diligence process? Because the right questions often matter more than having all the answers. They help us really uncover how strong the founders are, how real is the opportunity, and whether the traction truly signals product market fit or is just a creation or invention of the founder. So first, let's start with evaluating the founder. I think that's the first pillar. So from your perspective, Luis, what are the most important questions to ask to the founder and why?
Okay. So explain me what you're doing. That's number one. So explain me the business model. What is the opportunity? Why are you so keen on developing a solution that addresses that problem? And explain me why is that a problem. If we get past that stage, then I will go deeper on definitely just following the three priorities that I said before, understanding the team. And when I say team, it's as important the founders, whether the people that they're surrounded themselves with, or in certain moment, and I'll steal from David from David Olivencia, one of his webinars, you need to also take in consideration who else is at the table, what need to invest, because those people you need to they're going to be co-investors with you, and you also want to see who else is investing. So the team in general, the internal team, the deal team, the other investors. Um, from there, I think you really need to jump into a little bit more of the total value proposition, right? So if I understand what they're trying to do, and I get to know the team, and I get excited about the team, okay, let's talk about why is this even? It could be the greatest thing on earth, but the market is zero, so who cares, right? So explain me. Let's understand the market size, and let's be a little bit more holistic. It's just not only the market size, but I want to know I want to know what you as a founder think that are your weaknesses. So let's go through a SWOT analysis: strength, weaknesses, opportunities, threats. Which are the things that you see that is your strength, your weaknesses, your opportunities, your threats? From there, it's important to consider really what is the business model, the go-to-market model, uh, and eventually, obviously, once I understand all that, yeah, let's talk about the market size, because obviously you would prefer to play in a market that you have a lot of upside because there's a fragmentation, or there's not a leader, or there's an unattended high market, or a new opportunity coming. Obviously, I would love to invest every time in things that are higher potential to grow, right?
Let me ask a question there in the market. Usually, the estimates of the founders or the startup are very optimistic. They present trillions of dollars of market.
Yeah.
How do you properly evaluate the market size? For you, what's
That's that's why I knew you were gonna ask me something like that. That's why I left that to the end, because, you know, it's difficult, but that's where, at least to my advantage, what I'm doing, the space that I play, which is the space that I know, I can call bluff, and I can just you can. One tool that I use is, you like to put in perspective. Somebody says billions, okay, so that's equivalent to the total revenue of this company, or okay, that's equivalent to the total profit of this company. Just put something comparable in perspective to try to bring the reality check in a very polite way, call their bluff if I think that they're exaggerating it. Now, they can. I don't those projections that tell me, oh, we're going to grow 50 or 70% every month, every year, but they don't have a proven track record of doing that. Those are red flags, right? So you're going to claim that you can grow at a pace, or you can address a market certain size. Okay, you're going to have to go through the details, explain me how you got to that number. So I will be, honestly, I will get a lot more critical and aggressive in the positive sense, a lot more diligent in trying to understand their assumptions. I'm sure they have assumptions. Just I want to understand them to see whether I agree with those assumptions or not.
yeah. No, I agree. And for market, I have at least two frameworks that they work really well. I don't like the top-down approach of markets. I prefer the bottom-up approach of market. And it's very simple. As a founder, how many customers
Mhm.
do his like he thinks that he has or he will have? Approach like in a rough estimate in the market, and times the ACV that he has today, at most double the ACV that he's having today, annual contract value. And the second framework is okay. I know that that's your big market, but tell me the market that you are targeting on year one, the market that you're targeting on year two, and the market that you are targeting on year three. Then then you multiply it times the ACV, and you get really the opportunity that he's going to.
Yeah, because and that's part of basically we're similar approaches, but different and there might be different methodologies. But at the end, it's trying to put perspective to their numbers, understanding the assumptions, understanding the pace of growth, showing what you've shown as a baseline revenue the last 6 months, customer acquisition, customer retention, right? So things are important that start to give you a better sense of whether that solution has legs to consider investing. So
Yep. And that gives me to like the third topic of the questions that we need to ask. It's about the traction that you were mentioning. And sometimes there you said that there are different metrics: sales, customer adoption, cohort retention, and net dollar retention. Let's go one per one. What are usually the tricks that founders make on sales? How you can discover the true sales of a startup?
yeah, the classic one that I've seen is we have projected sales based on we're very close to land these contracts. We have these customers. We have three customers that we're already talking, that we're 2 meetings away from getting them, and they have a significant market. So they and I respect their job. They're trying to sell you the potential. and if they don't have something to show, they need to sell you on the potential. You know, once you have the fiduciary obligation as an investor using someone else's money to decide investing on something, you need to be careful, right? You need to be very deliberate and consider and understand whether that's really has strong foundations or not. That's why I'm a lot. I want to understand how they think on growth, but I'm definitely just okay. Show me what you've done, right? And you need to be balanced because you need to give them credit. You know, in recent times, one of the companies of Angeles that I think we all love, like Nurable, right? There's a lot of potential. There's things, but even in that example, those of you that are familiar, you know that there's things that are already happening and things are under contract, and there's something that are more binding obligations from customers, not just I think I'm going to close a customer tomorrow. So
Yeah, so that's also why I like to see pipeline and the pipeline evolution over the time, and that's in the case of Neurable something very positive that he was able to show traction in his pipeline when revenue was a little bit more difficult. But also, other thing that I would like to see is I like the cohort analysis, especially when you are more in the Series A or late seed stage. You can already see how cohorts are behaving, and if you see if the retention is going down, especially in the older or elder cohorts, it's a red flag. It's a red flag. You have to see how much is the retention of the company, and especially if it's a SaaS. So that, like, I would say that the metrics that I like to see are sales, pipeline, and cohort analysis, basically.
yeah, I would ask, depending on the company, it could be, if it's more of a B2C, it could be more users and user retention. I think that's also a good indicator. I think, there's examples that, in the Angel's portfolio as well that are based on customer retention, customer growth. That's important. Um, yeah, I think all those are, at the end, going to your original premise of this session, right? It's a little bit of a science, a little bit of an art, but the part of the science, you need to put very deliberate effort on not jumping, not everything that looks flashy or interesting ends being that way once you peel the onion and you do a thorough due diligence. So the rigor of the diligence is super super important.
I agree. And before jumping to the last set of questions that I have, I want to also give the possibility to the audience to ask questions. So feel free to put in the chat your questions, and we will read them after the last section that we have right now. So let's move to the most important question. You have all the due diligence done. You have a memo. You have the one pager. Everything. At least we have an investment committee. We go to discuss there in the investment committee. What is the questions that you ask yourself, Luis, before approving or rejecting an investment?
You know, at that time when you're about to put money in, definitely is a moment that I want to understand how am I going to get the money out eventually, right? So I think that's probably the most critical at that juncture, that it looks good. Everything is promising. But okay, I'm gonna put X amount of money. So how am I gonna exit? So that's the moment that I think we need you need to understand from the target investment. What are their thoughts on exit? Are they building because they think they're gonna get and they can be the next great thing and run by themselves to an IPO? I would argue that only a very small number of companies become IPO. So that wouldn't be, if that's the only thing that a founder is thinking, it will give me a little hesitation. I think when you get to have a conversation that they think of exit because one of their investors is a corporation and they are one of the lead investors and they see an exit to that corporation, that's interesting because you know that corporation is investing on that startup as a funnel of innovation and external R&D, trying to build the solution to really eventually really acquire them as a big part. So you see how you're going to get your money out. Um, so long-winded, but I would say the exit potential and not necessarily the timing, but the how it's going to exit. The timing could be consequential of multiple things, but do I see that company eventually returning the money to the investors? And if at that moment the answer is no, probably it should give some hesitation about should we be investing or not. So
I love that question. In fact, I will include it in. Well, we asked that question in the due diligence, but not. It's not our last question in the IC. I will add it into the list. But we have another question at the end, like at the end of the IC. It's like this is the right jockey that will be able to capture that market and probably have the exit that you're forecasting with. It's like we
yeah,
start in the founder, the team, and we finish kind of in the team because
yeah,
basically
no,
that's.
you're absolutely right, and the most mature status, you think there's a lot of cases that the investments start not. I think more like a horse race, using the jockey example. I'm thinking more like a relay race, right? Not the runner doesn't have to be the same person at every stage on the race. So you need someone with certain skill sets to do the first run, to open some distance to the other ones. Then you need a couple relays that are going to maintain and just go full speed, trying to create the traction. And eventually you need the closer, right? So you need, your star at the end that is going to be the closing. So mature companies, and you see it, the person starts as CEO, and then you have a CTO, and suddenly there's some swaps on the roles, or they bring someone from the outside because they recognize that in order for them to really monetize their effort investment, they're going to need a different jockey, to your analogy. So I agree. It's funny, but at the end, things are start and end. The people component, even in today's world, that we all think AI and you're trying to optimize through technology, and that's a passion of mine around technology. But at the end, the people component is super important when you see when you consider an investment. So.
Yep. No, thank you for sharing that perspective, Luis. We have some questions from the audience. We have a question like, do you require 5-year financial projections, or how much do you consider them in your analysis?
So, so if this was private equity, yeah, I will be looking for 5 year financial projections and that. Reality is a lot of these startups at the stage that you invest, at least that I invest, that we invest really, is seed and Series A, right? So they don't have 5 years of financial history. So you want probably from the beginning, or at least ideally the last 24, 12 months at least, to have some projection. Ideally, I would say you want to be able to see if there's any seasonality in the business. At least 2 full cycles, 2 full years will be ideal, because you see up and downs. Their revenues derived by seasons, one-time events in the market. So at least with 2 years, you can compare and contrast. But the reality is, investing on seed and Series A, a lot of times you don't have that. So
Yeah.
that's why you use growth and customer base and retention and other things as proxies to that. So
Yeah, financial information or statements we usually ask for 2 years, but sometimes the startups are growing that fast that they only last like 12 months are the ones that we look at. And then for projections or forecasts, usually we ask for the financial model to understand the the thinking process of the founder and how structured he is. But taking into account that they will meet their forecasts or projections, especially 5 years down the road, I think it's a little bit naive. But for sure, we like to see how much revenue he's projecting for end of year one, and year two. And then each month that goes into the diligence process, see that he's meeting the forecasts that he did or he showed us in the beginning. And gets to your point, Luis, before, that if a founder is not able to prove the forecasts or projections in the next couple 1, 2, 3 months, why he will be able to meet his forecast at year 4, 5, 6 of the startup.
yeah, at the end, when you do the due diligence, at the end, what you're trying to do is, and especially more in startups, and you're trying to get as much information. You're looking you're looking at something and you want to look it from all different perspectives, right? So you want to turn it around upside down, just so you can have the financial perspective, the technology perspective, the commercial perspective, the solution perspective. One thing that we didn't talk, and I probably was my omission of not mentioning it, but you know, to me, the moment of truth is show me. Okay, and what I mean by that is I want a demo. I want to see what you're talking about. I want to see it in operation. I don't want you to tell me and you be doing the clicking. I want to tell you click on that, click on that, click on that. I want to see how it works. Okay, it's part of my bias towards understanding the solution up front. Uh, that's just me, but to me, uh, you know, I have an advantage playing in a space that I know well. That that allows me. If I get excited after a demo, oh, then definitely I want to go quick and I want to look at the financial, the technology, all the other components. But by then, I'm excited. I'll still be very rigorous and very deliberate on not investing someone else's money because I got excited about something. But that would be step number one. So a demo is, you know, to me is it tells you a lot.
I agree. And there is another question about deal dynamics. Like, what do you look in deal dynamics? And that's referring about who are the VC joining and who, like, what you like to see and what you don't like to see in a round coming and shaping up. And second is how you make those questions to founders. Because if you do it in an incorrect way, the founders will always say like we have a lot of traction momentum. Like what are the questions that you make to founders to know and to capture those green flags or red flags?
Probably that's why I go back to explain what you're fixing so I can understand their biases because a lot of them that once they explain you, they're they're putting their heart because they're trying to sell you their solution, right? So you pay attention to what they're telling you. They tell you a lot, willingly or unwillingly, trying to preposition how they're going to justify the investment. So I think that's why being very alert about if they're overly indexing on highlighting the customer retention as an example, I might be more critical. They're trying to understand why and whether that has grounds or not. Um, it's up, it's again, it's I'm not a shy guy. Okay, so if I have a question, I'll ask it. I'm very deliberate. I'm not I'm not aggressive, but I'm firm. And if once we get to due diligence, I don't shy out of asking tough questions. And I adhere to the philosophy of trust but verify. So okay, I believe what you're telling me. Show me, and and I love there's a methodology in engineering that is called the five whys methodology. That is just if somebody can hold five whys of questions, that level of depth, uh, that tells you a lot. Most people won't get past the second or third why. That's the reality of the understanding, or they'll start babbling, or they'll start just trying to go tangential and trying to just sell you to the peripheries of the solution, right? So it's a couple of I'm not going to call it trick, but my I've been blessed over the years to have been involved in so many things on M&A and looking at customers and looking at technology solutions and that gives me I have a reference point normally, and I believe on compare and contrast. That's the other thing. It's not a trick, but it's important to do that compare and contrast. If they are trying to sell a solution that is similar to something I've seen, I try to bluntly ask, okay, how does this compare to this company or that company? Try to understand how they think in the competitive landscape, right? So
Yeah, I love it. I love it. I just want to add in the deal dynamics is that you want to see, and I think you spotted on it in the beginning of the session, you want to see other investors also joining the round.
yeah,
That's a one, a, a lead investor, and also the founder to tell you the truth about where they are in the round and how they want to structure it. Not just kind of seeing what the market will tell him, but hey, I want to do right now a seed round, will a save. In 1 year from now, I will raise a Series A. that Series A will be around a 2x markup at X valuation, because that will let me like to hire X amount more people and go for an X revenue. So all that kind of analysis, I love it. And also what I love to analyze is that if existing investors are joining the round and really understand if they're not joining, why they're not
Yeah.
joining.
Yeah, of course. When somebody, the philosophy of investment, right? You invest on Series A because you want to invest. So you invest on seed because you want to invest on Series A because likely you're going to be able to get even a critic value for investors just by you know helping a seed organization go to Series A because valuation will go up and naturally just marks up the investment. So you want them to go there, but but you need to see whether they have the how they're thinking to your point about getting to that round. And the other one is, sometimes reality is fonts our size, Angeles size, the size I'm trying to build. It's you don't lead a lot of rounds, right? That's the reality. You're a smaller fund in the scheme of things, and you need to also having and seeing who invested first and seeing them reinvest, that immediately to me is somebody is giving them already a thumbs up, at least at that stage. And if you understand, goes back to the team, if you understand those potential investors, their philosophy of investment, how they've done other investments, and you like what they've done, to me, you don't need to know everything about every company you invest, but you need to know how others think about them and um, what's the track record of those other investors, because that will inform your decision as well, right? So
Yeah, 100% agree. And I know that we're in the top of the 30 minutes. So I want to, before we wrap up, I would ask Luis if you have any final takeaway for angel investors. What is a piece of advice on startup due diligence for angel investors?
advice. So, so I don't know. I think we all invest in things that we all have our own biases, the things that we like. Uh, I'm just sharing my own perspective. So one thing that I highlighted up front a little bit, but maybe I'll just finish with that just to reinforce how I think. And again, don't. This is not an advice, a recommendation for anyone to invest, right? I'm just sharing my perspective. You guys can develop your own thesis, but goes back to, do I see an exit? Which are the alternatives? Which are the risks? Then are they focused on what they want? In my case, supply chain. Are they really focused on that, or they're trying to be jack of all trades, supply chain marketing? Because there's some startup that want to be jack of all trades. Um, the stages, right? Depending on on what you want to invest, you and I we've been in conversation companies, Francisco, that Series B's or C's that I would love to invest. They're out of scope, right? They're not within what a fund this fund can do. So don't get biased, don't lose time on that. Understand the assumptions, eventually the financials. Differentiation, I don't know if we used that word before in this conversation, but you know, there's not always differentiation, but at least the differentiation could be goes back to which problem they're trying to fix. It's not necessarily it's something absolutely new, but it's, are you fixing an old problem? And to me, that's differentiation. I think talent, we already exhausted that topic, so I'll skip that one. And really, well, we talk a little bit about the value proposition, right? This SWOT analysis, what is the technology stack, their competitiveness, their growth potential, go to market, TAM. You can use, there's all kinds of assessment that you can do. And at the end, that momentum, right? Whether it's revenue, customers, users, that traction, that drive, is it happening? And really, once you go through a couple of the diligence, you start getting a sense and a feel, and you know, and you need to be careful to separate. The only thing is, not everybody is that there's some founders that might not be the best at selling their solution. Doesn't mean that their solution is not worth the it's not worth investing. So I want to separate that, but at least you need to see a little bit of passion and drive. Whether they're not the best at selling, I don't know that that's relevant as long as their solution is valid and they get someone to help them on that, right? So it's just again, just sharing a little bit how I think about it, and I'll by now I've been I invested in several startups and the fund, and trying to do this with this different fund. So I don't compare myself with, I'm partnered with David and Adele and you because you guys have done this a lot of times and you have a lot of experience. But by now I'm starting to feel more and more informed and strong about the rigor of deal making, and and again, the due diligence process is super important before putting money in. And probably for anyone that at any time considers that, how you gonna get your money out? I think that's important. I don't think nobody puts money in something without expecting something, right? So that's the way you should think about investing, right?
Yeah. And I have two recommendations for angel investors. One in the due diligence side, kind of separate emotions from decision making, and that's with mainly three questions. Is the solution like do you see the market of the next solution a big thing that will be the future of it? Do you see that the founder can grab that market opportunity and the momentum that he has shown? Even there are great founders that they are serial entrepreneurs and they have had great results. But if he has or he's not a or he has not been able to show momentum, traction, revenue growth, or customer growth, like maybe you have to wait. And that's also a possibility. Like wait, monitor the opportunity. So that's one, like separate emotions from decision making and monitor or wait if it's the time to be. And my second recommendation for angels is if you are an angel investor, build your portfolio. It like you need to diversify your investment. Like you cannot invest in one or two companies and that's it. You need to there. This is a very risky asset class, so you need to be diversified. At least with 10, I would say, investments. So like then you will have more similar returns to the VC asset class because if you invest in one or two that are the ones that you were really excited about, probably will be a one or zero type of return. So,
Okay.
okay, with that said, very good discussion, Luis. Thank you for sharing all your knowledge. And thank you for the audience for joining us today. We hope you are leaving this session with a practical tools and fresh perspective to strengthen your investing journey. And on behalf of Angeles investors, thank you again for being with us. And we look forward to seeing you at our next sessions and next summit in New York.
Thank you,
Thank you
Francisco.
all.
Great conversation.
Bye bye.